Hey everyone, welcome back to my channel. Today I want to cover a very difficult and complicated topic I've wanted to cover for some time, however needed to ensure I understood it well enough to simplify it for anyone newer to dealer positioning. I've covered Gamma to great detail and now plan to do the same with Vanna. I'll go over the basics of Vanna and then cover some beginner level practical ways to use it. Before we get started, I'll leave several discount codes for trading services I use in the description, including TradingView, Voland, and Elite Trader Fund. Lastly, if you enjoy this content, don't forget to like and subscribe to help me grow this channel. It really does help the channel grow and it means a lot. With all that being said, let's get right into it. So the first thing I want to talk about that I haven't talked about before is that Vanna is actually greater than Gamma, meaning it has a bigger effect from a market maker perspective than Gamma does. And I'll talk about some of the nuances involved with that in a bit. But first, I want to just talk about why I've started using Voland for this information as opposed to other services I've used in the past. And don't get me wrong, I love TradingView, but one thing to note about them is that per their dealer positioning data, they only show options that occur at the bid or the ask. They can tell if there was definitive buying or selling. Voland actually takes all of the dealer positioning data, everything that happens with the options flow, takes all that into account and then makes assessments based off having the complete picture. And then other services, even outside of those two, don't even oftentimes look at things like Vanna the way they should or have proper data. So it's been difficult to get great insight into Vanna, which is a very powerful mechanic. And thankfully, and Voland is really one of the only tools I know out there that can accurately depict Vanna and what's going on there. And so to talk about some of the basics, Vanna is based on the relationship to implied volatility to the underlying asset. And as a rule of thumb, whenever IV, well, first of all, with IV rising and dropping, Vanna will dictate how market makers, how hedge funds, the dealers that are providing liquidity to the markets, how they actually are going to change their hedging requirements if they buy or sell. And so, as a rule of thumb, IB typically rises when price drops and falls when price rises. However, we need to make sure that we always verify that. And we can do that by looking at the options chain, as showed here, by looking at implied volatility. Or we can do so as a quick reference by looking at something like VIX, especially for trading the S&P 500. And so, another note about Vanna that's very important. You can see by this chart here, this is a very helpful chart. Vanna makes its biggest impact when we are about when the delta on the underlying options contract is about 0.2 to 0.3 away from being right at 100, and then when we're actually in the money, when the delta is roughly 0.7 to 0.8, it has its biggest impact. So when we're actually on the strike itself, it has zero impact. It's always its biggest impact is when we're approaching or passing is when Vanna really comes into play as a hedging mechanic. And so there's two types of effects that Vanna can have, or actually three types. So the first one I want to talk about is the Vanna magnet. So when hedge funds dealers are long the options contract, meaning they bought contracts that institutions are selling, which we should always confirm with Gamma, and I'll show how to do that in a bit. Vanna will show as negative below the current underlying asset's price, and it will show as positive above the current underlying asset's price. And this actually creates a magnet effect, which I'll show. I mean, it creates that pinning effect that we oftentimes see. A lot of times that gets mistaken for Gamma. Gamma actually doesn't create that magnet effect. Gamma is more local to particular strikes. Vanna is the actual reason why we see price magnet or pin to certain levels. And oftentimes people think that's Gamma doing that incorrectly because they'll see a large amount of Gamma at a level, but the reality is it's actually because there's a large amount of Vanna at that level as well. And so Vanna is the real reason behind that magnet effect. And Vanna, on another note, when dealers are short, so they've sold options to large institutions who are now long those options contracts. So those institutions have bought calls or puts. That means dealers, hedge funds have sold those calls or puts typically, which again, we should confirm by looking at Gamma as well. Vanna will show as positive below the current price, and it will show as negative above the current price. And in this scenario, where that's the case, it will act as a repellent, and it will push price away from those strikes. And And if we have a magnet somewhere in between 2 points, then that will further increase that pinning effect that we see. And however, one important distinction, this is like the third effect really, is if it crosses those repellent areas where we see price being pushed away from due to Vanna hedging requirements, if it crosses those, it will act as a massive accelerant. So I'll show this on SPX momentarily, but if we have a large amount of negative Vanna above the current price that is repelling it, and has been repelling it for some time, and then all of a sudden IV starts dropping, institutions start buying, as we see price move up, we cross that area, it will act as an accelerant and will help price just fire past that area that was previously repelling. So this is the chart of what I'm actually talking about. So if we look at the SPX view today on Voland, we can see that this positive Vanna here, and this is a huge amount of positive Vanna here at 38.50, and there's some more positive Vanna up here at 3900. This will act as repellent. So if price were, which we're pretty far away now, so it's unlikely, but let's say price were to fall past here, due to Vanna hedging requirements and a large amount of them at 38.50, market makers would have to do a huge amount of buying. So we would see IV drop, we would see IV rise as price drops, and then this would act as a repellent. All of a sudden price would start moving higher, and then in theory IV should start dropping with that. Now the same can be said for these strikes up here. So this is negative Vanna above the current price, so these are also repellents. Positive Vanna below, negative Vanna above, repellents. So 4100 here. Now this level, I should note, was much bigger last week, which is very interesting. The Vanna here has been diminishing, but this has been acting also as a repellent, keeping 4100, keeping us capped at 4100, keeping us market makers pushing away from here. So as IV continues to drop, so if we see something like VIX continue to drop and this Vanna continues to diminish, or even if it doesn't, but we get pushed past this area, we'll see a massive acceleration past 4100 based off the Vanna hedging requirements, because market makers will now be forced to buy along with the move higher, and it will create a nice move up until we get to the next large Vanna areas. And of course we should factor in things like positive gamma that's above us that could also act as repellent. Now here you could see at 4,000 we have negative Vanna below spot price. So this was a negative Vanna above spot price. Now we have negative Vanna below. This changes. Instead of acting as repellent, it actually acts as more of a magnet. So based on the large amount of Vanna here that we see, we could see that the way institutions have to hedge due to this, that we're more likely to be drawn to 4,000 than we are to be pushed away from it. And so that helps paint a picture right now, because ever since the big move from Jerome Powell's speech when he talked about lowering interest rates and everything, and in the coming months he's not going to raise them as much, talking about 50 BPS, we had a massive run up. However, we sort of peaked right around 4,100, and Vanna played a large part in that. And then since then we've sort of been falling back, which could also be attributed to Vanna's assistance. And so that's the kind of picture Vanna can paint, and it's very useful when you're assessing the underlying ticker. Now, the thing is that we should always pair this with the chart, right? It should never be used on its own. It's always great to look at the chart, look at consolidations. I use smart money concepts and volume profile that I've talked about a ton on this channel. We should also verify with gamma. So gamma has more of a local effect when we're actually near the levels where there's large amounts of gamma, and that gamma also impacts market maker buying and selling. And when gamma and Vanna are in line with each other, that's where we have more of an impact for market makers. And also when there's more gamma and Vanna that needs to be hedged. We also want to confirm that our IV is doing what we would expect it to do and correlates properly with price movement. So IV drops as price goes higher, or rises as price goes lower. And again, confirm with VIX or the options chain. And Vanna has a much bigger impact than gamma. I've already said this, but it should be noted that market maker activity is not everything. So this should be used as an edge, not as gospel, right? So don't ever think that market makers alone dictate exactly how markets will move, because they don't. There's so many forces at work in the markets, and we need to always take that into account. So having this data, though, can give you a significant edge. And one thing I'll talk about in the near future, after covering this more beginner level stuff, is how we can formulate option spreads, horizontal spreads like calendar spreads, or vertical spreads like credit spreads, whatever it might be, how we can structure spreads to take advantage of this market maker data, which is very useful, especially for swinging plays and looking at expirations to see when Vanna and things like that will fall off. So if you want more information into how Vanna actually works under the hood, I highly recommend checking out the AdDM YouTube channel. That's the creator of Voland, and they do great deep dives into all of the option Greeks, whether it be the primary Greeks like Vega or Theta, or the secondary Greeks like Gamma, Vanna, and Charm. They break all that down to much greater detail. I'm going to be focused more on practical applications. So that being said, let's take another look at SPX. So what I was talking about here, so we have positive Vanna below the current price, which means that market makers, this will act as a magnet. And we want to also confirm, will market makers buy as we approach that magnet? And that's where we can look at gamma, and we could see positive gamma here, which means as we approach it, they will indeed buy. And there's a significant sum. So that's important to distinct as well. So anyway, I hope you found this helpful. I know it's a lot of information I threw at you, and it's very complex. If you have any questions, please let me know, and I'd be happy to try to help answer them if I can. Thanks for watching.